Welcome to the Deep Dive. We plunge into the, sometimes pretty dynamic world of international trade. Imagine you're running a business, right? You're making payments, maybe receiving them across borders, and then bam, the currency exchange rate just decides to go on a roller coaster. How do you protect yourself? How do you shield the business from those, wild swings that can really hit your bottom line? Today, we're doing a deep dive into a really powerful financial tool that companies use for exactly this risk, foreign currency futures. We've got some really detailed sources here looking at two different methods, both totally valid for handling these kinds of transactions. And we're going to reveal something honestly quite surprising about how futures can actually make those future currency costs incredibly predictable. Like surprisingly so, even when the market's volatile.
Yeah, exactly.
Yeah.
Our mission here today in this deep dive, it's not just to break down these methods step by step, though we will do that. It's also to show you how companies try to, lock in an exchange rate and what that really means for their financial security, for their planning.
Okay, great. Let's unpack this. A concrete scenario usually helps, right? So imagine a company, Norris Co. They're based in the Eurozone. They need to pay $20 million to a supplier over in Mengia. Their currency is the dollar. Now, the payment's due November 30th, but today is May 1st. That's a big chunk of money, and it's quite a long time, 7 months for currency rates to wobble around?
Oh yeah, this is absolutely textbook foreign exchange risk, a classic scenario. If Norris Co. does nothing, no hedging, they're completely exposed. If the euro weakens against the dollar between May and November, that $20 million payment is going to cost them a lot more euros.
Right. So before we jump right into the futures, let's quickly touch on maybe a more common alternative people might think of first, using the forward market. Just a quick clarification for everyone listening. A spot rate is like today's price right now. A forward rate is different. It's a rate you agree on today for a deal happening later. It's a pretty direct way to just lock in that future rate.
Exactly. So for Norris Co., if they went this route, they'd look at the 7-month forward rate. Let's say it's $1.2274 per euro. Their $20 million payment would then convert to $20 million divided by that 1.2274 rate. That gives them a cost of $16,294,606. Nice and exact.
Okay, so the forward contract, it seems like it offers that kind of precision, a fixed number. But what are the downsides, the trade-offs if Norris Co. uses a forward?
Well, you're right. Precision is definitely the big plus. It's tailored perfectly, to the exact timing, the exact amount Norris Co. needs. And these are significant drawbacks. First, there's counterparty risk.
The risk the other side doesn't pay up.
Exactly. The risk the bank or whoever they did the forward with want or can't fulfill their side of the deal. It's less common with big banks, but it's there. And crucially, once you're in that forward contract, you are locked in. There's no flexibility. It's not liquid. You can't easily get out or change it if, say, your payment date shifts or the amount changes. Gotcha. So it's tailored but rigid. Okay. That leads us nicely into futures then. They're standardized, you said, but offer maybe different kinds of advantages. How would they work for Norris Co. here? Remember, they need to buy dollars, which means selling euros.
Right. So futures are standardized contracts traded on an organized exchange. That standardization and the exchange acting as the middleman basically eliminates that counterparty risk we just talked about. Big advantage right there. Now, for Norris Co., yes, they need dollars, so they need to effectively sell euros. The main futures contract is actually on the euro, priced in dollars per euro. So to hedge, they would need to sell euro futures contracts.
Okay, sell euro futures.
And timing-wise, they need cover for November 30th. The futures contracts have set expiry dates like March, June, September, December. So by May 1st, the June and September ones aren't useful because they'll expire too early. They'd have to use the December contracts.
Makes sense.
And each of these standard December euro contracts is for a set amount, $125,000. Okay, $125,000 per contract. So how many does Norris Co. need for their big $20 million payment? Is it just simple division?
Almost. It's a two-step calculation. First, you got to translate that $20 million payment into euros, but using the futures price, not the spot rate. Let's say the December futures price on May 1st is $1.2310 per euro.
Right.
So you take $20 million, divide by 1.2300. That gives you the sort of euro equivalent value represented by the futures. Then you divide that euro amount by the contract size, the 125,000.
Okay, let's see. 20 1.23 $1, then divide by 125K.
Exactly. And when you run those numbers, it comes out to 130.1 contracts.
0.1. But you can't trade 0.1 of a contract, can you?
Nope, you can't. Futures contracts have to be whole numbers. So Neresco would round to the nearest whole number, meaning they'd use 130 contracts.
130 contracts.
Yeah. And that little bit of rounding, that 0.1 difference, that actually means the hedge isn't perfectly matched to the $20 million. It's a small detail, but it's important, and we'll see why it matters later.
Okay, good point. So they've sold 130 December Euro futures contracts on May 1st. Now what? Let's get into the methods for actually figuring out the final cost. You mentioned two. Let's start with the lock-in rate method. Sounds straightforward.
It often feels that way, yeah. It's a way to estimate your effective exchange rate without needing to guess what the actual spot rate will be on November 30th. It relied on understanding this concept called basis.
Basis, okay.
Basis is just the difference, the gap between the spot price today and the futures price today for that future date. So spot minus futures. On May 1st, our example spot rate was 1.210. The December futures price was 1.210. So the basis is 1.210 minus 1.2300, which equals negative 0.0200.
Okay, minus 0.0200. What does that basis represent?
It reflects things like interest rate differences between the two currencies, market expectations. Fundamentally, it's the cost or benefit of carrying the position over time embedded in the price difference. Now, the absolute key idea here is that this basis isn't static. It predictably shrinks. It diminishes towards zero as the futures contract gets closer and closer to its final expiration date.
Ah, okay, so it converges.
Exactly, converges to zero at maturity. For these December contracts, maturity is effectively December 31st. So what we need to figure out is how much of that initial basis is still unexpired on Morris Co.'s actual transaction date, November 30th.
Right, they're closing out their position a month before the contract actually expires.
Precisely. So think about the total time. May 1st to December 31st, that's 8 months, right?
Yep, May, June, July, August, December, 8 months.
On November 30th, there's only 1 month left until December 31st. So 1 month out of the original 8 months remains. That means the unexpired basis on November 30th should theoretically be 18th of the original basis.
Okay, so 18th of that minus 0.0200.
You got it. Minus 0.0200 times 18 gives you minus 0.0025. That's our unexpired basis on the day they'll make the payment.
Right, minus 0.00025. So we have the starting futures price, 1.2300, and this unexpired basis, Nash Euro 0.005. How do they give us the lock-in rate?
Simple addition. The lock-in rate is just the opening futures price you started with, plus whatever basis is expected to be left on your transaction day. The 1.2300 plus that negative 0.00025, that gives us 1.2375.
$1.275 per euro. That's the effective rate they've locked in.
That's the estimated effective rate, yes. Using this lock-in rate, Norris Co.'s expected cost for the $20 million payment would be $20 million divided by 1.2275, which comes out to $16,293,279.
$16,293,279.
Okay. And remember, the beauty of this method is it gives you a really solid estimate of your likely outcome, your euro cost, without needing to gaze into a crystal ball and predict the actual spot rate on November 30th. It assumes the basis behaves predictably.
That's really useful. A solid estimate without forecasting. Okay. Now, let's tackle the second method. The future spot rate method. This one sounds like it does involve some crystal ball gazing, asking us to assume a future spot rate.
It does, but it's not really about prediction. It's more about demonstrating the mechanics of how the hedge works.
Yeah.
It shows you how the futures gain or loss offsets the change in the spot market cost.
Ah, okay. It's illustrative.
Precisely. So let's just pick a number. Let's assume that on November 30th, the actual spot rate turns out to be $1.2265 per euro.
Okay, 1.2265.
First step. We need to figure out what the futures price should be on that day based on our assumed spot rate and that unexpired basis we already calculated. Remember, basis is spot minus futures. So rearranging that, the futures price should be the spot price minus the basis.
Right. So 1.2265 minus that unexpired basis of negative 0.00025.
Exactly. 1.2265 minus negative 0.0005. That actually means adding 0.00025. It actually means adding 0.000000. Okay. Now, Norris Co. sold futures back in May at 1.230. Correct. They sold at 1.2300. Now they're effectively buying them back, closing the position at 1.2290. They sold high and bought low.
So they made a profit, a gain on the futures market.
They did. The gain per contract is the difference in price, 1.2330, 1.2290, which is $0.0010 per euro. Multiply that by the number of contracts, 130, and the size of each contract, 125,000.
Okay, 0.000101013 euro, 125,000.
Gives you a gain of 16,250. That's US dollars.
$16,250 gain from the futures hedge.
Yep. But we need the final cost in euros. So we need to convert that dollar gain into euros using the spot rate on that day, our assumed rate of 1.2265. So $16,250 divided by 1.2265 gives a euro gain of 13,249.
Okay. 13,249 in gain from futures. Now, what about the actual payment they have to make?
Right, the mean event. Norrisco still has to go to the spot market on November the 30th and buy $20 million.
Yeah.
At our assumed spot rate of 1.2265, that $20 million payment costs them $16,306,563.
Okay, $16,306,563 cost on the stock market.
So you have the spot cost and you have the futures gain.
So the total net cost for Norrisco using this method is the spot cost minus the gain they made on the futures.
Exactly. $16,306,563 minus that $13,249 gain.
Which equals $16,293,314.
$16,293,314. Now, step back a second. Compare that to the result from the lock-in rate method.
Whoa, okay. The lock-in method gave us $16,293,279. This one gives $16,293,314. They're almost identical, like what, 35 difference?
Tiny difference, right. And that tiny difference is purely down to that rounding effect, having to use 130 contracts instead of the theoretical 130.1.
Yeah.
But what this calculation really shows beautifully, I think, is how the hedge works. The spot rate moved, we assumed it went down slightly, making the dollar payment a bit more expensive in euros.
What?
But the futures position made a gain that almost perfectly offset that increased cost. It stabilized the final outcome.
That's really clear now. Okay, so let's compare futures to the forward market for Norrisco. What's the verdict?
Well, financially, the futures outcome, let's call it roughly $16,293,300, is actually marginally cheaper than the forward market hedge, which costs $16,294,616, a small saving.
Okay, a little bit cheaper. But you mentioned other benefits earlier, the non-financial ones.
Absolutely, and these are often the clincher. Futures offer really important non-financial pluses. One is flexibility. If Norrisco's plans changed, maybe the payment date shifted, they could close out or adjust their futures hedge pretty much any time before maturity. You can't do that easily with a forward. And the other big one, as we said, is basically zero counterparty risk. The exchange guarantees the transaction. That's huge peace of mind compared to a forward.
Right.
The only tiny downside in this specific Norrisco case was that rounding. Using 130 contracts instead of 130.1 meant the hedge wasn't 100% efficient. It didn't cover exactly the $20 million exposure, leading to that very slight difference between the two futures calculation methods and a tiny bit of remaining exposure.
That makes total sense. Flexibility and safety versus perfect tailoring but rigidity and some risk. Okay, let's flip the script now. Put the shoe on the other foot. What about the company receiving the payment? Let's say it's a Mengene company getting $15 million from Norrisco on that same date, November 30th. They want to lock in the dollar value of those euros.
Okay, good scenario. So a Mengene exporter receiving euros, wanting dollars. Let's look at forwards first, quickly. They'd be selling euros forward for dollars. Let's say the relevant forward rate for them is 1.2308. So 50 million multiplied by 1.2308 gives them a guaranteed $18,462,000.
$18,462,000 locked in with a forward. Okay. Now, how about futures for them?
Right. They're receiving euros, want dollars. So they need to effectively lock in the sale price of euros. But the futures contract is on the euro. To hedge receiving euros, they need to buy euro futures contracts initially. This seems counterintuitive, but they buy futures now, and when they receive the actual euros and sell them on the spot market later, they'll simultaneously sell their futures contracts. The net effect works.
Okay, so they buy December euro futures. How many?
This is where it gets interesting. Their exposure is $15 million. The contract size is $125,000. So $15 million divided by $125,000. It comes out to exactly 120 contracts. No rounding needed.
120 on the dot. That sounds significant based on what you said earlier.
It is. This 100% hedge efficiency, being able to match the exposure exactly with whole contracts, is really key for the insight we're building towards.
Okay, intriguing. So they buy 120 December euro futures. Let's use the lock-in rate method first for them. Basis might be slightly different.
Yeah, let's assume the spot for them on May 1st was slightly different, say 1.2116. The future price is still 1.2300. So their initial basis is 1.2116, 1.2300 equals 0.00000. The unexpired portion on November 30th is still 18th of that. So net is 0.0184 times 18. That gives 1.000023.
So the lock-in rate is the opening futures price, 1.2300, plus the unexpired basis, 0.00023.
That gives 1.2277.
1.2277. And they're receiving 15 euro million.
So the expected dollar proceeds are $15 million multiplied by that lock-in rate of 1.2277, which results in $18,415,500.
$18,415,500 using the lock-in rate method. Got it. Now let's do the future spot rate method again for this Menjin company. This is where you said it gets really interesting because they had that perfect 120 contracts. Let's pick an assumed spot rate for Nov 30th again. How about 1.2310, a bit higher this time.
Okay, 1.2310 it is. First, calculate the expected futures price when they close out. That's the assumed spot 1.2310 minus the unexpired basis. Minus 0.00, so you're minus negative 0.0023.
Because it gives 1.2333.
1.233. Okay, now remember, the Menjin company bought futures initially at 1.233.
Exactly. They bought at 1.2330, and now they're closing out selling at 1.2333. They bought low, sold high. Another gain.
We said.
The gain is 1.2333, 1.233, which is $0.0033 per euro. Multiply that by the 120 contracts and the 125,000 contract size.
Gives a futures gain of $49,500.
Okay, $49,500 gain. Now, what about the euros they actually receive?
They receive their $50 million payment. They go to the spot market and sell those euros for dollars at our assumed spot rate of 1.2310. So 15 million times 1.2310 equals $18,465,000 received from the spot transaction.
$18,465,000 from spot. Now, the final outcome for them.
It's the dollars received on the spot market plus the gain they made on the futures market. Wait, sorry, slight correction there. They bought futures initially. The gain on futures reduces the effective cost or adds to the effective proceeds, depending on how you frame it. Let me rephrase for clarity. They receive $18,465,000 from selling the euros. Their futures position also made a gain of $49,500. Now wait, that logic is slightly off for a receivable hedge gain. Let's rethink. Okay, think of it like this. The hedge locks in a rate. The spot transaction brought in $18,465,000. The futures transaction resulted in a gain of $49,500 relative to the initial futures price. The total economic effect needs netting out. Let's trace the cash flows carefully. Spot inflow, $18,465,000 from selling 15 euros at 1.2310. Futures gain, $49,500. Profit from 1.230 to 1.2333. The simplest way is often cost minus gain, or proceeds plus gain minus loss. They'll use the structure from the source. Okay, the source implies the gain offsets the spot transaction to arrive at the hedged outcome. So the final outcome should be the spot result adjusted by the futures result to match the locked-in expectation.
Let's reconsider the Norris Co. payment calculation structure. Cost on spot minus gain on futures gave the net cost. For a receipt, it should be proceeds on spot plus gain, or minus loss on futures, right? No, that doesn't seem right either. The hedge gain loss should counteract the spot movement.
Okay, maybe think about the target. The lock-in rate gave $18,415,500. How does this method get there?
Right, good anchor point. Okay, the spot rate, 1.231 yen, was higher than the lock-in rate, 1.2277. So selling euros on the spot market brought in more dollars, $18,465,000 than the locked-in amount, $18,415,500. That's a difference of $49,500 extra on the spot market. And the futures position also made a gain of $49,500 because the price went up. So wait. Did they gain twice? No, that can't be right. The hedge must offset. You start that specific calculation flow clearly. 1. Spot transaction. Receive 15 euro, sell at 1.2310, get $18,465,000. 2. Futures transaction. Bought at 1.2300, sell at 1.2333. Gain equals 1.2333, 1.230, 125K equals $49,500. Net result. The source logic must be that the final cash position reflects the locked-in rate. If the spot rate is better than expected, the futures hedge makes a loss to counteract it. If the spot rate is worse, the futures hedge makes a gain. Let's check my futures calculation again. Buy at 1.2300, sell at 1.2333. Yes, that's a gain of $49,500. Let's check the spot outcome versus locked in. Spot, $18,465,000 is $49,500 higher than locked in, $18,415,500. Okay, so you see the confusion in my explanation. The structure used in the source notes must be treating the futures gain loss as the adjustment needed to get from the spot outcome back to the hedged outcome. So perhaps the final outcome calculation in the source was meant as.
Spot proceeds $18,465,000 minus the relative overperformance compared to the hedge target, which happens to equal the futures gain. $49,500. No, that feels forced. Let's stick to the core idea. The final net dollar amount received should be the locked-in amount if the hedge works. Spot inflow, $18,465,000. Futures gain, $49,500. The total cash generated seems higher. Let's reread the source logic. Okay, maybe I misread the example structure earlier. For the payment Norris Co., it was spot cost futures gain equaled net costs. For a receipt, Menjin Co. should logically be spot proceeds plus futures gain if price rose as they bought. Net proceeds. Let's try that. $18,465,000 plus $49,500. Futures gain $18,514,500. That's not the lock-in rate result.
This is actually highlighting how tricky tracking the cash flows can seem. But what was the final number in the source for this method?
The source material states the final outcome is $18,415,500, matching the lock-in rate. Okay, let's trust that and work backward. How does $18,465,000 spot and a $49,500 futures gain result in $18,415,500? It must be that the gain-loss on futures offsets the deviation of the spot rate from the effective locked-in rate. The locked-in rate was 1.2277. The spot was 1.2310. The spot was 1.0033 better for selling euros. That difference on 15 euro is 15 euro 0.00033 equals $49,500. The spot market proceeds were $49,500 higher than the target lock-in amount. The futures hedge also produced a gain of $49,500. The calculation shown in the source must have been presented as spot proceeds $18,465,000 minus futures gain $49,500, net outcome $18,415,500. This achieves the target outcome, but the sign seems counterintuitive for a gain. Let's assume the logic is the hedge ensures you get the lock-in result. The spot market gave you X, the futures market gave you Y, gain loss. X adjusted by Y must equal the lock-in result. So spot $18,465K was above lock-in, $18,415 by 49 every 5K. The futures must have generated an offsetting effect. Here it generated a gain.
Okay, this is actually fascinating because it's exposing a potential complexity or maybe a standard convention in how these are presented. But the key takeaway from the source was?
The key takeaway, and apologies for the calculation detour there, the key finding was that the final calculated outcome using the assumed spot rate method, $18,415,500, was exactly the same as the outcome predicted by the lock-in rate method. $18,415,500.
Exactly the same, to the dollar, unlike the Norris Co. example, which had that tiny rounding difference.
Precisely. And why were they exactly the same here? Because the Menjin company could use exactly 120 contracts. The hedge efficiency was 100%. There was no rounding error.
Okay. So what does that imply? Does it matter what spot rate we assume?
This is the surprising insight. Let's test it. Let's assume a different spot rate for November 30th, say something lower, like 1.220.
Okay.
Expected futures closeout price equals 1.2200. Spot managed 0.2200. As is 1.2200. They bought futures at 1.2300, now closing at 1.2223. That's a loss this time.
Right. Bought high, sold low. Loss.
The loss is 1.23000, 1.22223. 120.25K equals $115,500 loss in futures. Now, the spot transaction. Sell 15 euro, 1.2223 loss, $18,300,000 proceeds.
Okay, spot proceeds, $18,300,000. Futures loss, $115,500.
Now, let's apply the source's apparent calculation logic consistently. Spot proceeds adjusted by futures gain loss to hit the target. Target is $18,415,500. Spot proceeds, $18,300,000, are $115,500 lower than the target. The futures hedge produced a loss of $115,500. So the structure seems to be spot outcome plus MECA futures gain loss, final net outcome that equals the lock-in rate prediction when the hedge is perfect. Let's re-verify. $18,300,000, but it's not $15,500 to offset the futures loss. No. How does $18 3M at spot and $115 5K futures loss get to $18,415,500? Doesn't directly add up that way. Okay, the fundamental economic point the source is making, despite my struggle articulating the intermediate calculation steps shown, is this. Because the Menjin company had a 100% perfect hedge, 120 contracts exactly, any movement in the spot exchange rate away from the effective lock-in rate is perfectly offset by an equal and opposite gain or loss on the futures position.
So the gain or loss on the actual currency conversion is canceled out by the loss or gain on the financial hedge.
Exactly. When the hedge is perfect, the two sides perfectly balance, the spot rate becoming less favorable. You make a gain on futures to compensate, the spot rate becoming more favorable. You make a loss on futures that cancels out that extra spot gain.
So the final net outcome, the actual dollars they end up with,
remains locked at that $18,415,500 figure, regardless of what we assume the future spot rate to be. Whether we assumed 1.2310 or 1.2200, the net result, after accounting for both spot and futures, is the same.
Wow. Okay, that is a powerful demonstration. When you can hedge perfectly with futures, the future spot rate truly becomes irrelevant to your final outcome. You've genuinely locked it in.
That's the power of it. It removes the currency risk entirely for that transaction, achieving precisely what the hedge was set up to do.
Okay, so final comparison for the Menjin customer, futures versus forwards.
Again, Futures proved financially better on paper. The locked-in $18,415,500 compared to the forward rate outcome of $18,462,000. So they received slightly fewer dollars with futures in this specific price scenario, but they got the benefits.
And the non-financial benefits.
Same as before, the flexibility to adjust or close the position early, and no counterparty risk thanks to the exchange. And in their case, the 100% hedge efficiency really highlighted the stability that a perfectly executed futures hedge can provide. It worked exactly as intended.
This has been really illuminating. So bringing it all together, what does this mean for you listening, whether you're looking at company accounts, maybe running a business yourself, or just curious about how global finance actually works day to day?
Well, we've walked through two really powerful ways to handle currency risk using futures. You've got the lock-in rate method, great for a quick, solid estimate of your final cost or proceeds. And then the future spot rate method, which, despite my little tangle there explaining the calculation convention, really demonstrates the mechanics, how the futures gains and losses are designed to offset the spot market movements. And crucially, both methods, when you account for basis risk properly, give you very, very similar results. What's really compelling, I think, is seeing how futures, with that package of flexibility and basically no counterparty risk, can often be a superior way to hedge compared to forwards, especially as we saw with the Menjin example, when you can get that perfect hedge efficiency. The way they're designed to automatically counteract those spot market swings is, well, it's quite elegant, really. It shows the power of these financial instruments when used correctly.
It really does. And it leaves us with maybe a bigger question for you to think about. When you're faced with uncertainty, maybe it's financial, maybe it's something completely different in your life, how much value do you put on locking in a predictable outcome? Getting that certainty versus keeping things flexible, maintaining options, and perhaps seeing how these complex tools work. Does it change how you think about managing risk or uncertainty in your own world? Something to ponder.